This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Man, every time I hear that song, and I'm not some big fighter or anything like that, but every time I hear that song, I want to put a pair of steel-toed boots on, go to Boston, and get into trouble. That song just reeks of trouble. But no trouble today on this podcast. Just some thoughts, some excerpts, pulling from here and there to try and bring an interesting point across. One of the great things about the author, Jack Schwager, is he created the concept in trading books of timelessness, especially in his book, The Market Wizards, and his book, The New Market Wizards. Jack went ahead, and this is going back to what, 1988, 1989, 1990. Jack laid out very cleverly through interview with some of the best investors and traders around. And still to this day, many of those names, you don't forget them. But what he did was weave throughout those two books timelessness, principles, risk management, basic trading precepts that don't change. Human nature doesn't change. So for those of you that might say to yourself, what good is a book written 25 years ago? Well, you sort of missed the point. The reason Daniel Kahneman, the reason Vernon Smith won the Nobel Prizes for their behavioral economics and behavioral finance work, I would argue, can be originally found in Jack's books. It's right there. The thinking, the thought process. You can't miss it. It's a grounding. You feel grounded when you look at those two books. You feel like, okay, I know where the best stand. I don't need to reinvent the wheel. Oh, but you say to yourself, I'm 22 years old. It's 2015. I'm going to invent a whole new canvas, a whole new cropping of paints, and everything will be brand new. And this stuff from all these years ago where guys like Ed Seykota and Larry Hite and Bruce Kovner and George Soros and Richard Dennis and Van Tharp and Charles Faulkner and Tom Basso. Well, that stuff at Bill Eckhart. How could I forget Bill Eckhart? All that stuff. That's not relevant to me today in 2015. I've actually seen people say that the Market Wizards books are not useful. People that you would otherwise think are intelligent, people that you would otherwise think have some trading or investing experience, actually say that the Market Wizards books have no value today in 2015. Let's make a simple rule, a simple heuristic. If someone tells you that the Market Wizards books have no value in 2015, one of two things. They're either trying to sell you something or they have lifted your wallet while you're not looking. You should probably right now reach back and touch your ass to see if you still have your money. Is the wallet still there? Because it's probably gone. And one of the great basic ideas, principles, foundational concepts introduced in Jack's books was the notion of a system. Now, of course, Jack's not the first person to talk about a system. I've seen Wall Street books going back hundreds of years. Having a system is smart, but Jack was one of the first people to do it in interview style with the best traders. And to be without a system, to just kind of sit there on your intuition and your gut, and that's how you're going to make decisions. Well, boy, is that problematic. Let me add a view on systems from Howard Lindzen of StockTwits fame.
Any system better than no system.
Love this. Read it, understand it. When Jerry Parker, as one of the original Turtles,
The band?
The Turtle Trader has managed as much as $2 billion, now really just small, managing family money in managed futures, trend following a mutual fund. Really dove in that even though the S&P, for example, where we tell people to dollar average into the S&P or a Vanguard ETF of the S&P 500, any system is better than no system. So as much as
just imposing some sort of systemic
structure
process on your trading is better than
including just investing in the S&P, which is a rudimentary system because it replaces stocks and adds stocks in and just does it for you. Even though that's rudimentary, 99% of people can't beat it, and professionals can't beat it, which isn't to mean you can't beat the system. It just means you have to have a system to beat another system. And the fact is, what was really interesting about Jerry too, and I don't think people really understood it, was that this is the era of investors, meaning computers, coders, people like thinking. You don't have to be on Wall Street. This is the perfect era for investing.
Because imagination, technology's caught up, and the stock guys have the imagination.
Can do it. And what's super interesting about that is we keep selling something else to this generation. We're lying to them because everybody else sucked at it and had no systems, and now we have the tools to systematically do what the Turtles did in 1980s because Richard Dennis was the only one who would spend money on computers, is we keep telling people they can't do it. So I'm super bullish by that. Jerry Parker, even though he was only up for a short period of time, blew my mind with simple stuff.
And so keep it simple. Everyone thinks they're Luke at the end of Star Wars, where he's going to flip up the visor and he's going to use the Force. You're not Luke. The Force was strong with
You're not Luke.
You're going to panic and you're going to miss the hole.
But everybody should have a little Luke in them, in the sense that trading is not bad. Investing on your own outside of a system is not bad. People are going to do it. The Stock Twitch traffic proves that people do. Motley Fool, Street.com, Jim Cramer on CNBC. The numbers may not be Twitter-like or Facebook-like in terms of people who want to do it themselves. Just because a system matters doesn't mean you shouldn't also be imaginative and try and beat the S&P with a small portion of your portfolio.
Before instinct. It's you react well only after you actually have some foundation, as opposed to I am nature boy kicking off my shoes and going to make magic trades.
The system protects you from being a human, but being human allows you to be who you are, meaning trying to get Amazon over Walmart is a fucking great thing. It's a freedom of this country. So that everything that he says is true, but I would also add having your own individuality and sometimes a little piece of no system and imagination will help you trounce the market.
Howard and Jeff Mackey make a great point in that conversational excerpt from, I guess this is from Howard's Stocktoberfest 2015 wrap-up. But they're on target about a system. The S&P is a system. Invest in a mutual fund, that's a system. The question becomes, what type of system do you want? What are the trade-offs, the risks and the rewards? What type of life do you want to have? Have you done your homework to know what all of the systems are, the pros and cons? Have you done the work? But even with that wisdom, which I think can be just seen across so many pro traders, we know the system is the way to go. It does not surprise me, however, though, that there are market voices out there. The same types of market voices that will tell you the Market Wizards books are dated, those same types of voices will tell you they look at a chart, they have no system, they just have a feeling, it's intuition, and that's how they make their decisions. Absolutely trust me on this. Whether you're new or experienced, the top of the heap, best in show, the highest achievers, absolutely don't trust themselves. They trust themselves to develop a system. They trust themselves to have rules. But when they put that system in place, they are not sitting there like in the cockpit, ready to override at any moment. They have to have trust in their original research and their original homework, in those rules that they have developed, to stick with them. Because if you find yourself as some guy who has a subjective feeling about some chart pattern, I mean, sure, go at it, have fun, pretend, make it all up, but you're not serious at that moment in time. You're not playing serious. You're half in the game. Maybe you're not even half in the game. Maybe you're just kind of sitting on the sidelines and no one really cares, including you. Because how can you really care if you're going to talk about subjective chart reading, for example, when all of the evidence, whether from the systematic traders that we can go back decades of experience, whether we look at that evidence, whether we look at the evidence from Daniel Kahneman, Vernon Smith, whether we look at that evidence, Robert Shiller, the behavioral side of the equation, systems win. Speaking of systems, I would like to play an excerpt, an older excerpt, and I don't think I've added this to my podcast yet. An older excerpt from one of the single best systems traders ever, Bill Dunn.
So our investment style is that we are medium to long-term trend followers. Our approach is quantitative. That is, we have computer models that have been developed from historic studies, statistical studies of the behavior of the various futures that we trade over as long a history as they have. And that means for new futures, typically that's 4 or 5 years as a minimum, and for ones that are longer established, that sometimes is 15 to 25 years that we've analyzed. We exercise no discretion whatsoever in executing the orders that are generated by our computer models, and we simply do not override these models or these signals. And the markets we trade are global, exchange-traded futures that have large trading volumes, so that we are able, with our clients' funds, to move in and out of these markets without upsetting them or giving them the impression that we are the leader instead of the follower. We have serious risk management programs in place and always have, and our target to design a program is for each program to have a 1% probability of having to experience a loss of 20% or more in a 1-month period. Now that risk level can be changed by the client to either a higher risk or a lower risk. We've shown a few examples of events that you may have recalled seeing. This is the October 87 stock market crash, where the S&P lost about 22 and we lost about 2. Here is the August 88 Asian crisis, where the S&P lost around 16 and we gained about 22. The point here is that there is no correlation, and again, we'll talk about that in a moment, as why you shouldn't expect any. This is an example of how our WMA program trades a market. This has been picked because it was a particularly favorable market for our particular model. This is 18 months of the Japanese yen. As you can see, it went up and down. There were some significant trends, so we should have had an opportunity to make some money, and it turns out we did. Since the WMA is a reversal system, it's always in the market. It's either long or short, trying to follow and identify the major trends. While this is the first signal that's shown on the chart, we obviously must have been short coming in here, and this rise here was enough to tell us we should quit being short and start being long. And it seemed like a pretty smart thing to do about this time after we saw that happen. Then we had a significant retracement which caused a short signal here. Now, there's something to note here is that this rise seems very small in comparison to this drop that took to get the short signal. Well, the reason is because our program and our model has always incorporated near-term volatility. This volatility here is far less than the volatility that was going on here. So it took less of a change from the previous recent market to give us a change in direction here than it did here. Also, because the volatility is very high here, this rise was, while it's much larger than this, was not enough to give us a long signal. And as a result, we rode this short position for nearly a year, all the way down to here when we got a long signal, which was wrong, and we reversed and went down to the short. Now, that was a very, very good market for our program. But some markets are not so good. And this is a not so good market. This is the same exact period of time, and the British pound was truly miserable here for us. As you can see, we were buying tops and selling bottoms, and this was a very poor way to try to increase our clients' equities. But this kind of behavior, even in something like the British pound or something that isn't working for a while, it doesn't continue forever. And also, it's just one part of our portfolio, so we have more diversification. So we are able to live through these disappointing times also. So our characteristics are that we only trade in high volume markets on exchange regulated exchanges. And because of that, we have virtually no credit risk, because it is the exchanges and the clearinghouses that guarantee validity of all these contracts. So we have virtually no third-party credit risk, nor do our clients. Our positions and our trades are completely transparent, because we will tell our clients, either the broker tells them directly or we tell our clients what trades we've made every day and what our positions are. So there's nothing secretive about where we are and how we got there. Our performance is not a result of anybody's judgment, mine or anyone else that works for us. It is a result of long-tested computer simulations and models. Our risk is very actively managed, and because this program is a reversal program, it will go short a given future as often as it goes long. So for these reasons, because it trades a different kind of a portfolio of different kind of investments than most asset classes, and because it is likely to be short as well as long at any given time, this is why you would have expected, if you knew nothing else about it, you would expect this kind of a program to have zero correlation with all other asset classes, and it does. We do have low correlation or zero with all other asset classes. What do we bring to the table? Our contribution is that, number one, we bring a very, very long history of high performance under different and changing economic and political conditions. We bring a near zero correlation with all other asset classes, and we bring a very strong likelihood of doing very, very well under very difficult times. Thank you.
If I think about what Bill Dunn just said, and I hearken back to my original comments about Jack Schwager's books, if I add in Howard Lindzen's thought on systems, now you can easily say, Mike, you've just picked a few excerpts here, big deal, I don't care. Really? You don't feel and hear something worth paying attention to? It doesn't strike you that this might be important? Someone asked me the other day, they said, Mike, why is this stuff so under the radar still? Why is it so hard for people to access this type of information, to access this type of thinking, this alternative way? Ladies and gentlemen, the system is against you. The system does not want you to have success. The system is about a supposedly efficient market. The system is about buy and hold value investing. That's it. Your only choice if you follow the system. And I'm not talking about the trading system. I'm talking about the system. The hand of God system, the hand of God government system is what I'm talking about. That system wants you in servitude. That system wants you broke. That system doesn't want you to think. It's up to everyone to figure out who the wizard is and where the curtain is. Are there multiple wizards? Are there multiple curtains? Are you looking behind the right curtain? Do you even know who the wizards are? Do you even know that you're being manipulated? Find the wizard behind the right curtain, and you've got a chance. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.